We got another edition of Jedi Options coming down right now, and I believe you're going to be teaching our community a little bit about the Theta Research Spreadsheet. And for those of you who are familiar with the Theta Research Spreadsheet, this is just going to be par for the course for you guys, a nice little review. For those of you who are not yet using the Theta Research Spreadsheet, this is a trading journal that we designed over the course of the last 12 years. Basically, we use these spreadsheets to do research for potential credit trades, whether we're talking about bull puts, bear calls, iron condors, naked puts, covered calls. This spreadsheet is it's called the Theta Research Spreadsheet. It is there for credit type systems. And what I love about the spreadsheet is you fill out the data, it does all the work for you in terms of helping you understand two very, very, very important metrics when it comes to understanding the quality of one credit trade, one naked put, one covered call versus the other. Too many times, traders make too many decisions on ROI, return on investment. As an old trader, as a veteran trader, that is not part of the assessment. It's part of the equation, certainly, but it's not the end all be all. You got to be looking into account at ATR ranges and ROID. And so let me speak to those two very quickly, and then I'll just kind of turn it over to you, Ty, to let you kind of fly. The spreadsheet is designed for you to fill out the data. And then what happens is it will then fill out the performance metrics based on the data that you do put into it. So for example, you put the symbol, the price, you put the ATR, the current ATR on the daily chart. The month is not necessarily important. It's just there to kind of understand. But what is important is DTE. It stands for days till expiration, because sometimes we'll be looking at a 42-day contract versus a 28-day contract. Sometimes we'll be looking at a 35-day contract versus a 28-day contract. And we want to see how those performance metrics are scaled against an average of a 30-day contract. And so what days till expiration is just how many days you have until the expiration of that option. Strike price is obviously the strike price you're looking to sell. The delta is the short delta the delta on the strike price. ATR buffer is not something that you fill out. It will be based on the price versus the ATR. And what it will tell you is how many average days do you have between the strike price and the stock price that you're dealing with. And that is extremely important to understand your buffer here. You talk about the word moat, right? Fundamental moat. Microsoft has this beautiful moat. Well, when you're selling a credit spread, you want to maximize the range. You want to maximize your probability. And so you want to look at the ATR buffer, and that will be based on whatever amount of days you have in days till expiration. That will tell you what that standard ATR buffer is. Now, the standard ATR buffer, the next column over, that will compare it against a 30-day number so that you can analyze this on different time frames. The net credit is just whatever credit you are receiving from the contract sold. Buying power effect is the amount of margin you have to put up to receive that credit. The alert will be automatically placed in there. Now, what the alert is, ladies and gentlemen, is the danger zone on most credit systems are when you get underneath the strike sold or above the strike sold. And so, for example, on a naked put, the danger zone is if you sell an 18 put option and all of a sudden it's at 17. Well, what the spreadsheet will do is it will tell you where you can put an alert on that chart based on 1/2 ATR above the strike price sold on a bullish type credit trade, or 1/2 ATR against the strike price sold on underneath a bearish type position. And so that just gives you a helpful understanding of where to place an alert on the chart so that you don't get into those ultimate danger and risk zones in credit trades. And once you fill out the data here, all of a sudden the performance metrics will be filled out as well, and you'll be able to cross compare all these different theta type trades so that you can pick the ones you feel are the best. Now, in the performance metrics, and we'll talk about this after Tyler fills out FCX, you're really not looking at one very important number here, and that's ROID. Now, for those of you who are new to tackle trading, you might never have heard of ROID. And for some of you, even at tackle trading, you may have never heard of ROID, because ROID is not an indicator that the market uses. ROID is an indicator that I created. I created ROID it's been about 12 years ago now. And how ROID was created was, I was looking at about 20 different credit trades, and I was still in the process of not learning, but really understanding my personal approach to selling bull put spreads, bear call spreads, iron condors, naked puts, or any cash flow system. And when I was first taught how to do credit trades, legitimately, I was taught, as long as you get 10% of credit versus the spread, you have a good trade. Well, my analytical mindset could never understand that, because you could go out to the market and you could sell a 10 delta contract and get 50% against a $5 spread, or 50 cents against a $5 spread. Well, that's 10% of spread. And then I would go out and I'd sell a 25 delta contract and I'd get 50 cents against a $5 spread. And I'm like, well, those aren't the exact same quality. There's got to be something left out here. And for me, what really was left out was understanding how to also take into account your delta, which equates to your probability versus the ranges you are selling. And so what I did was I created ROID. And what ROID is it takes your ROI, it divides it by your delta, which is your probability, and then the performance metrics will highlight whether or not that is a good trade according to the systems that we teach at Tackle Trading, such as cash flow condors, Tackle 25 covered calls, boomerang trades, and so on and so forth. And so what ROID does is it will basically standardize your ROI that you're receiving on the credit trade. It divides it by your probability, and then the scale will identify whether that is a good or a great type of trade based on just the pure numbers behind it. And ROID to me is something that has helped me navigate for a decade now of separating what a good credit trade is from a great credit trade. And so ROID, ROI divided by delta, that is the number I'm focusing on the most. The second number, however, is the ATR range. And so as you fill out this spreadsheet, the two most important numbers for me personally is the ATR range. That shows you the range you have to deal with. That's your moat. Your ROI takes into account the combination of your ROI you're receiving on the credit divided by your probability, which is delta. And with that explanation made, Tyler, Jedi options.
Right. So just thank you for that introduction, Matt. Good explanation. So some numbers will help you digest the explanation Matt just gave. But I do want to mention, Matt, so these journals for pro members of Tackle Trading, they're under the Trade Center. Yeah. Right here, Trading Journals, right? That's the webpage you go to download these when you're a pro member. But what we're going to do here is we're going to use FCX, and we already kind of analyzed the chart. So, let's say that you like the company and either you're willing to buy it, but you want to get paid to buy it, or you just want to build a higher probability bullish leaning trade, and so you want to use a naked put to do that. Remember the dynamics on a naked put. You're selling a put option. We're not buying options, we're selling options. And in this case, as in most cases, when you're selling an option, you hope it expires worthless. For that to happen, we need the put to stay out of the money. And so if I sell a 35 put, then I'm betting FCX stays above 35. If I sell a 33 put, then I'm betting FCX will stay above 33. If I'm selling a 30 put, I'm betting FCX will stay above 30. Obviously, I have a better chance of winning selling a 30 put than selling a 35 put. But as a result, they're not going to pay me as much money, right? There's this eternal link between how likely you are to win and how big your payday is. And there's an inverse relationship. If you have a 99% chance of winning, they're not going to pay you very much. If you have a 50% chance of winning, they'll pay you a decent amount. So you kind of have to decide what's the right balance there. And using Royd, using Atr Buffer will help you balance how much money am I making and what is the likelihood I actually pocket that money. So you can use the Theta spreadsheet to compare different stocks, but in this case, I'm going to use it to compare different options on the same stock, just to get kind of an idea of maybe where I fit with my comfort level, maybe which naked put strikes the right balance between how much I get paid, and again, what is the probability that I capture that, right? So the other thing that's cool about the spreadsheet, for particularly as you're learning a strategy, is it reminds you at the bottom, what is this short put strategy? What's the theory behind the trade? What's my bias? What kind of trade is it? How do I know what delta to sell? What's my delta rule? What's my theta rule? All of that. So essentially, we want to sell a put that has a delta between maybe 25 on the high end, 5 on the low end. And I want to sell a put that's maybe about a month out. Okay, 1 to 3 months of time. 30 days is kind of a nice round number, 30 to 45 days. So that's the ballpark. That's the ballpark that I'm going to play in here for FCX. So I'm going to go to the trade tab, and the monthly option has 23 days left. We could try a 23-day option, but I'm actually going to go to the 30-day since it's right on the nose. We're going to use this weekly option. Now, weeklies are sometimes illiquid for some stocks. Others, they're a little bit more liquid. Quite honestly, as I look at this weekly option, it's pretty illiquid. Okay. And so I actually want to see. Yeah, see, the bid-ask spreads will tighten up as you get closer to expiration. Like the 9-day options, which are weeklies for FCX, have pretty good liquidity. And so sometimes you can get away with entering a 30-day weeklies options trade if you're pretty confident you're going to be in it for a few weeks. As it gets closer to expiration, those bid-ask spreads should tighten. So let's assume I'm comfortable with this, just so I can run the numbers. Okay. I do the 30-day option. Now let's fill out the first part of this spreadsheet here. So the ticker symbol is FCX. The stock price 39.52. This is going to be 30 days to expiration. It is a Feb option. And the strike price, I'm going to come back to ATR here in a second. What put would I sell? I got to have a delta column, and I want a delta between 25 and 5. So it's going to be one of these strikes. I'd like to compare selling a 20 delta to a 16 delta to maybe a 10 delta. So we'll look at 3 different ones and see what gives me the right trade-off here. So for the first one, I'm going to do a 20 delta, and I kind of need to have the midpoint here so I can know what's the middle of the bid and ask, since the spread's so wide. So let's call it 79 cents credit for a 20 delta. So the delta was 20. The premium net credit here was 78 cents. I'll round it up, 79 cents. And the strike price was 35 strike. And just while I'm here, 34 and 33 are going to be the other ones. So 34 strike, 33 strike. This has a 16, and then we'll round it up, 16 and then a 10 delta. So 16 delta, 10 delta, all 30 days to expiration, all February. Stock price is the same. And obviously the same ticker symbol. Okay. Now the credit, bouncing around a little bit here, but just trying to make it easy to get the numbers. So for the 34 strike, I would get about 60 cents. This is actually now 81, so let's up that, 60 cents. Or I can sell the 10 delta for about 33 cents. Okay. Now, what is the ATR for the stock? Well, I got to go back to the chart. ATR is about $1.96. And that's going to be true of all these. $1.96, $1.96, $1.96. Buying power effect is going to be, I think, the last number that I need. Okay, buying power effect. I don't know that until I build a trade. Okay, I don't know that off the top of my head. So I'm going to try to.
I'll get you those numbers while you kind of navigate, so you don't have to
Sure.
go back and forth, bro. So
Yeah.
you're selling, just very quickly, you're selling the 35, 4, and 3?
Yes.
I'll get you exact. Keep going.
Okay. While that's coming up, while he's getting that, let me mention one thing on this ATR. Okay. A $2 ATR for a $40 stock seems pretty high. It's like, what, does this really move 5% a day? If you bring up the ATR as an indicator, not just that little box on the top right, you get a little bit of context. And one of the things that you'll notice is the ATR is pretty high right now relative to what it usually is. And that's because FCX has been moving quite a bit. And the other thing I'm noticing is that the way the box is calculating it is a little bit different than the way the actual indicator is. They might have a slight change or difference in the calculation. I'm going to use the one at the bottom, the $1.80. In either case, the point I want to make is the ATR right now is kind of high. It's skewed a little bit high because we just sold off a bunch, right? And so that means that if your ATR buffer is not as big as you would like, you keep in mind that right now the stock has above average volatility, and that's probably likely to go down over time to where this doesn't move $2 a day like it looks. Right?
Yeah, can I say that? Can I speak to that very quickly?
Yeah.
ATRs, even outside of the volatility we're seeing in the market right now, ATRs usually do expand during earnings season. And so post earnings, you have to take into account a little bit of forward thinking analysis that ATR will come back down into an average range that is historically defined. And on FCX, yeah, it's moving at about 180 right now and 196. I think you easily could project here 1.6 based on just what you would expect an average ATR over the course of the lifetime of this trade, which is 30 days. So I just wanted to bring that up as well. Earnings does see an expansion of ATRs, and that can throw off the spreadsheet a little bit.
Yes, and specifically, what Matt's alluding to is because if the stock gaps a bunch, that gap, that big move, it could be skew the calculation for the next 14 days while it's in the data set, right?
Yeah.
All right, you got a BPE for me?
Yeah, these were simple on FCX. It's 10% on all of them, 350, 340, 330.
Right. Okay. All right.
On this one, yeah, it's
dollar.
Either that or you change the credit. You could either one. You just got to be consistent on that. Just
right. So if you state the net credit per share, the BPE's got
to do per share. Yeah.
Yeah. Whichever. Actually, I think it's going to jack up the.
Yeah, change it to the net credit 81
too.
versus 3. Yeah, there you go, buddy. They all got to be consistent.
Yep. Yeah. So. Yeah, if the delta is a whole number, the net credit's a whole number, the BPE is a whole number, or 100x, right? So, okay, I think that's enough data, right? I think we got it all in there. Mm-hmm. So let's break this down. Let's talk about the ATR thing just for a second. Part of the reason why Matt and I are harping on that is because if the ATR buffer, you'd like to see this above maybe 4, because it means your strike price is 4 ATRs away, right?
Yeah.
But to get 4 ATRs away, if right now the ATR is really high, is hard. And so you have to not necessarily penalize the stock or be too judgmental if the ATR is 3.5 or 3, if right now you think the ATR is artificially inflated, right?
Can I speak to that very quickly?
Yeah.
When you're looking at the ATR, anything under 2 is a no-go on a 30-day number. You just need more range, and it's hard to justify at any point. If that standard ATR number is red, I don't care what the credit is. It's very hard to justify that because you're just not getting the range necessary to justify the probability. And so, and there's always context around volatility, right? Well, increasing versus decreasing earnings, market volatility. There's always context there. But if you just stay true to that two handle, I've filled out enough of these numbers. It's never a good thing. Like legitimately, you cannot you can't overcome range from context. It's really hard. You can overcome ROI from context, but it's hard with ranges. Ranges are what they are. It's just math.
Yeah.
So you want to stay above the 2%. And then you got to understand one other thing. In dealing with a company like FCX, it's going to be damn near impossible because of who this company is and the type of ROIs and the beta this company has at any point to get above 4 on any delta, unless you're selling a 0.5 type delta contract, right? And so anything in the 10 to 20 is just going to be really difficult for a company with a beta the way that FCX has to get into that. That's why all the numbers are green on standard ROI. You have a higher beta type company, you have higher volatility, you're obviously going to get a little bit of a better credit over there. Well, to get that better credit, you're subtracting some of the ATR ranges. Now, if you were to go look at a stock with a lower beta than the market, the numbers will be flipped out. So if you're typically looking at some type of value type stock, you might be looking at maximizing ranges, but you're looking at yellow numbers on ROI. And so it's just understanding a little bit of the company you're dealing with. FCX is a little bit of a higher beta company. It's one of the reasons we love covered calls and naked puts and boomerangs on this company, is because we know the type of ROI we can get. The problem, you're just never going to be able to maximize as much as you want on the ATR buffer if you're projecting green, green, green across the board on the ROI. There's give and take to everything. You're giving up a little bit of range to maximize ROI on a company like FCX.
Well said. Well said. So the interesting thing here, you can kind of, first of all, this teaches you a lot about the way things are priced, right? And the trade-off you can never get around. So for instance, look at the ATR buffer, 2.5 ATRs, 3.1, 3.6. Well, obviously the bigger buffer is selling that 33 strike. Mm-hmm. Right? I get further out of the money. But there's a trade-off. You don't get something for nothing. You don't get a wider range, which transfers into a higher profit or translates into a higher probability profit without giving up something. Your ROI is 10% if you sell the 35 strike, which only gives you 2.5 ATR buffer. You're like, oh, that sucks. Well, does it? I mean, you get a 23% return. You're compensated for the reduced range of profit, right? Mm-hmm. So any one of these three, I think the first takeaway for me, Matt, any one of the three kind of fit the bill.
They're all, it's FCX. Like, it's not going to be a bad one across the board. It's post earnings volatility is still high. It's going to be good. But I will tell you, to me, there is one that stands out.
And that's what I want to talk about. So tell me how the ROID, they're all green.
So
tell me how maybe so tell me how the ROID is the moves the needle and is the technique or the number that says, okay, it's this one.
To me, when you're looking at, and again, I'm splitting hairs because they're all good, right? Yeah. If you were looking if you had a projection of higher prices on FCX and you want to maximize cash flow, it's 35 stands out. It's like, okay, we're getting a minimum of the ATR buffer. We're maximizing the ROI, but that's if you have that, man, FCX is going to get up and go off that 200-day moving average, right? You got to be projecting a little bit of higher prices. You got to be looking at a little bit of a technical edge there. And so if you have that technical edge, the same type of edge you would if you were a short-term trader, 35 stands out to me. You're getting a minimum number on the 2.5 and you're maximizing your ROI with the 116 standard ROID. That stands out to me. But if you're looking at the best trade here, right, just the best trade, because I don't feel like FCX has that edge. I just don't. It might, but I don't feel it has it yet, right? I feel like we've had enough constructive analysis to lob a grenade. I don't feel like we're market assassins here. We're projecting $45 print over the next week, right? And so I kind of feel like you're in the zone to start doing some cash flow type systems, but you still have a little bit of concern here whether or not we're going to hold that 200-day moving average. I think the 34 strike price really does stand out, and it's kind of that Goldilocks type thing. It's not too hot, it's not too cold. It's right there and kind of in the middle there. When you're looking at the ATRs, you got a very constructive 2.5, 3.1, 3.6. That's obviously going to be understood given the fact that, it's just calculating price versus strike on the ATR. But when you're looking at the standard ROI and the standard ROID, you're looking at you're getting a little bit of a higher return for that $1 lower strike price than you are if you go down $2. And so we're still getting 17.6% standard ROI. You're getting about 110 on the ROID. I think that one stands out just a little bit. So they're all quality. I think if you're looking to maximize cash flow because you got an edge, 35 stands out. If you're looking at Goldilocks and you just want to split the mid here, 34 stands out. You're getting 3.1 on ATR, which is perfectly fine on a 30-day number, 17.6% on the ROI. Everybody's going to be happy with that number. But 110 on ROID here really stands out with the three ATR range. So I can get 3 ATR ranges, which is I really, really like. That gives me 3 standard days of current market volatility going down, 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 down before it gets into any concern. That typically means you're a little bit oversold in those technical price ranges, and bounces are to be expected. So I do like getting underneath that three handle there. And I just think from an ROI versus ROID perspective, 17 and 110 stand out a little bit more than 10 and 100. And even with the 23%, I don't think you're getting enough ROID to justify it. So Goldilocks here plays for me. 34 makes sense.
Yeah, and I agree with the analysis. I think too, as you look to the chart, you're going to feel better about 34. And to your point,
especially if you're just pure cash flow here, if that's just your mindset, letting 35 work for you, I think makes sense too.
And I think from a trade management perspective, being short a put at 60 cents gives you more flexibility than shorting a put at 33. It's just hard to get out early when you only got 33 up front. So so final word here would be Feb 34 strike based on Theta spreadsheet, plus a little bit of preference.
There's some preference.
Yeah, I concur. I think that's the way to go. And the important thing is we didn't wing it, right? Like you had sound judgment behind your decision making, which is going to help you be more consistent over time, which should in turn then hopefully help you generate more consistent results, right?
Well, and we wanted to just use FCX in the example to kind of talk about the numbers and make the numbers very consistent. But when you're looking at the true power of the spreadsheet, it's when you're comparing 4 or 5 different potential bull puts, for example. And you're looking at one in tech, one in comms, one in this, and you're really kind of comparing against one another. I think that's where the true power really of the spreadsheet comes out. But if you haven't been using this spreadsheet and you're a pro member of Tackle Trading, definitely go download the spreadsheet. I know there's a lot of there's some tutorial videos on that as well, and hopefully this helped you understand using the Theta spreadsheet as well.